hybrid and electric vehicles, summation of the two. So when we look at this, again, there's a lot of questions that still remain. CAFE as well as affordability are the two big issues that we look at, and why we're again more on the pessimistic side for the outlook for these products. So to go ahead and wrap things up and get us back on schedule here, when we look at support, or we break it into two areas here: the support, or why we think we could see a little bit better expectations in terms of long-term production as well as long-term sales. Our view is post-recovery, we're looking for an economy or a GDP that's in the 3% range, 2.5 to 3%. I think that's pretty consistent with most out there. Replacement demand, right around 12 million units or so, again, should provide us a floor as we look forward. We heard from Rebecca about Generation Y. I think that's an important aspect as they start households, and we look for household growth. That's going to add somewhere in the range of 1 million to 1.5 million households a year, or buyers a year, I should say, over this period. And I talked about this earlier, but the fact that the baby boomers are not retiring as early as the previous generation, and if you're still in the workforce, most of those people are going to need vehicles to get to and from work. So again, I think that provides additional rationale for volume that may be a little bit higher than where we're at right now. Product activity, we know product activity drives buyers into showrooms. When you have that combined with the fact that credit will likely return to somewhat of a normal level, that leasing is back. Leasing in December was about 21% of total sales. It averaged 20 to 22% through most of the 2000s. So the fact that we're expecting leasing to be in that 18 to 20% range, I think, provides additional support in turnover for the vehicles, combined with that product activity. I think will keep people in showrooms. Some of the risks and some of the concerns that we're looking at in the longer term. Again, I talked about this a little bit, but buyers holding onto their vehicles longer. In 2005, it averaged 5.3 years on a trade-in. In 2010, actually, it was a little over 6. We expect that trend to continue as affordability continues to be an issue, and as we see overall incentive levels lower, pricing up. So that's contributing to the fact that the buyers are holding on to products longer, in addition to the overall quality improvements that we've seen over the years. I've talked about the lower percent of fleet sales as an impact. I think ultimately this balancing of inventory and incentives is very healthy for the industry, but puts some pressure, I think, on buyers and their willingness to come back into showrooms. And of course, CAFE and the price premium eventually that CAFE will put on the vehicle, which could be in the range of $4,000 to $7,000. A lot of estimates, a lot of unknowns related to where that ultimately will end up. That's a big driver, though, in terms of not only ultimate volume, but in the mix of the volume and what we will be driving. We do think that will, in one way or another, skew us towards the smaller vehicles, but we also don't believe large vehicles are going away at all. So with that, I'd like to wrap it up, and thank you very much.
Looking forward to participating with the other panelists. I'm going to go through a bunch of slides fairly quickly, and it will be available for you to peruse on your own on the website. But what I thought I would do is kind of set up where we are at this point in the recovery and what the outlook is from the Fed's perspective, both from the FOMC as well as with regard to the Chicago Fed. So with regard to the economy, we have seen growth now for 5 consecutive quarters. We'll be getting a look at fourth quarter GDP at the end of the month. But so far growth on a year-over-year basis has come in at 3.2%. This is above trend. We should be feeling all in all pretty good, although a bit disappointed from what we should be doing given how far we have fallen. But part of the reason why it hasn't felt all that good is the fact that over 60% of the growth over this period has been driven by the change in inventories. So these are goods that are produced, but they're not transacted in the marketplace. They're put on shelf for sale later. And the auto industry has played a major role with regard to this buildup as well. So when you remove the inventory story to look at what is actually being transacted in the marketplace, final sales, this has come in a lot lower than its historical average, which also is around 2.5% to 2.25%. So this is why it hasn't felt all that good. Now going forward, I'll kind of give a heads up. The view is that this year is going to come in above trend once again, but because it's not going to be driven by the inventory story, because probably the government stimulus is going to be, if anything, a drag as we move into this year, we're going to be certainly feeling a lot better with regard to that number, even though it's going to be not much better than what we have experienced in the past. Part of the reason why we've seen this sluggish recovery with growth that is roughly half of what should be occurring during this very significant, after going through this very significant downturn, is the financial crisis that we have been dealing with. And both when we look at periods back in the 1930s as well as internationally, say Japan, we have seen that recovery periods tend to be very, very restrained. One way of illustrating this restraint is to look at the Fed's balance sheet. I'll bookend it, first looking at the liabilities, and then at the end, I'll throw on our assets. When you look at our liabilities, you can see that prior to the peak of the financial crisis in the fall of 2008, our balance sheet was primarily made up of the currency in circulation, as well as the deposits that banks and financial institutions kept with us. And you can see that very tiny red shaded area that existed in that early part of the graph. Well, that's the reserves, the required reserves that banks have to keep with us. The latter portion of the chart there, where you see this swelling of red, well, that is the total reserves, which includes that tiny fraction that would still persist of required reserves, but all the rest of that is all of the excess reserves that are being kept there. This is ultimately going to be a very positive thing for the economy, because this will eventually, once banks kind of and other financial institutions return back to their normal mode of operation, represent opportunities for loans to be made. But at this point, consumers seem to have gotten a new religion with regard to savings. Saving rates have surged over the last couple of years, and surveys seem to suggest that these higher saving rates are likely to persist going forward. You know, not to highlight any particular company, but I do love this commercial series from ING, where it highlights why people should be thinking about savings and why they save. That everybody has a number they need for retirement. Now, how did you achieve that number? Well, in the past, of course, people would buy homes, they would let the equity rise, pay off the mortgage, and live off of that come retirement. Big part of their portfolio at the end of life. When you look at what has happened to the value of homes, where nationally things are off by 25% using the National Association of Realtors data, you know, in certain markets off by even more significant amount than that. You know, this has definitely hit the consumer balance sheet quite severely. Now, of course, the stock market is another big part of consumers' balance sheets, and this has been on a bull run, right? Since March of 2009, it's been up by 60% or so, and yet at the same time, people still don't feel all that great, and the reason is that we are still well below where we were back in 2007, let alone where this has traversed over the past 13 years, which is really nowhere fast. So I think all of these have played a role in terms of people being able to achieve their number. And with expectations, and I've asked people in the speeches I've given over the past year, it's been about 8,000 people, the vast majority, 95%, do not believe that home prices are going to rise substantially over the next 5 years. Probably about 90% do not believe the stock market's going to get them there. So in order to reach that number, they're doing it the old-fashioned way, saving out of income.